Chapter 11, Lesson 6, SLFRS 15, Revenue from Contracts with Customers. Objective of SLFRS 15. The objective of this standard is to prescribe the accounting treatment of revenue arising from contracts with customers and establish principles for reporting useful information to users of financial statements about nature, amount, timing, and uncertainty of revenue and cash flows arising from an entity's contracts with customers. The main feature of SLFRS 15 is it introduces 5 steps revenue model. The objective of this 5 steps revenue model is to recognize the revenue at the correct time and to record the revenue at the correct time. Now we are going to study this 5 steps revenue model step by step. Step 1. Identify the contract with the customer. What do you mean by a contract? It is an agreement between two or more parties that creates enforceable rights and obligations. Consider this example. You are going to sell 10 hand sanitizer bottles at 100 rupees each, and you are going to supply those hand sanitizer bottles within 1 week from the date of the order received. Now tell me, what are the rights and obligations of the seller? Seller's obligation is to supply 10 hand sanitizer bottles at 100 rupees each within 1 week of the date of the order. What's the seller's right? Seller has the right to receive 1000 rupees, 10 hand sanitizer bottles at 100 rupees each. Therefore, seller has the right to receive 1000 rupees at the time of the delivery of these 10 hand sanitizer bottles. Now we are going to consider the buyer's part. Buyer has the obligation to pay 1000 rupees on the delivery of these hand sanitizer bottles, and this buyer has the right to receive 10 hand sanitizer bottles at 100 rupees each within 1 week of the placement of the order. I think now it's very clear to you. It was a contract agreement between this buyer and the seller to supply 10 hand sanitizer bottles at 100 rupees each within 1 week of the placement of the order. Then a contract can be written, oral, or implied by an entity's business practice. Criteria for the identification of a contract. Number 1. The contract has a commercial substance. In the previous example, you have decided to sell 10 hand sanitizer bottles at 100 rupees each. Your objective was to maximize your profit. So it had a commercial substance. Second one, the parties to the contract have approved the contract. The buyer has placed the order and the seller has agreed to supply the goods. Number 3, the entity can identify each party's rights in relation to the goods or services to be transferred. both the parties, the buyer and the seller, have understood their rights and obligations. Number 4. The entity can identify the payment terms and conditions for the goods or services to be transferred. The seller is very clear about the supply of these 10 hand sanitizer bottles. The supply has to be done within 1 week of the placement of the order. Final one, it is probable that the entity will collect the consideration to which it will be entitled. And the seller is going to collect 1,000 rupees upon the delivery of these 10 hand sanitizer bottles. Now we are going to study step 2. Step 2. Identify the performance obligations in the contract. What do you mean by a performance obligation? It is a promise in a contract to transfer goods or services to a customer. Now we'll take our example. In that example, you have promised to supply 10 hand sanitizer bottles within 1 week of the placement of the order. That's the performance obligation. Now step 3. Step 3. Determine the transaction price. What do you mean by a transaction price? It is the amount of consideration in a contract which an entity expects to receive from a customer in exchange for transferring promised goods or services. When you take our example, supply of 10 hand sanitizer bottles at 100 rupees each. What's the transaction price? 10 bottles multiplied by 100 rupees. The transaction price is 1,000 rupees. Step 4. Allocate the transaction price between performance obligations. Now in our example, we had only one performance obligation, that is to supply 10 hand sanitizer bottles at 100 rupees each within 1 week of the placement of the order. Step 5. Recognize revenue when a performance obligation is satisfied. You have to recognize the income when you have fulfilled your performance obligation only. Seller satisfies performance obligation when the customer obtains the control of the good or service. Especially in the case of services, the performance obligation is satisfied when the service is performed. Okay, if you are going to sell some goods, then the seller satisfies the performance obligation when the customer obtains the control of that item. If you are a service supplier, the performance obligation is satisfied when the service is performed. Now we are going to learn these 5 steps using some examples. Example 1. ABC PLC signs a contract to sell a machine to XYZ PLC for rupees 20 million. The supplier is the ABC PLC and the customer is XYZ PLC. ABC PLC is going to supply a machine to the customer for rupees 20 million. Now we are going to write 5 steps of the revenue model. Look at my answer format. I have written step 1, 2, 3, 4, 5. Step 1, identify the contract with the customer. Then I have kept some space to write the answer. Same way, step 2, identify the performance obligation. Then I have kept some space. Step 3, determine the transaction price. Then again I have kept some space to write the answer. Step 4, allocate the transaction price between performance obligations. Then I have kept some space. Step 5, recognize revenue when a performance obligation is satisfied. And then again I have kept some space. Okay, take 3 minutes and be ready with this format. Look at the question again. The transaction is ABC PLC signs a contract to sell a machine to XYZ PLC for rupees 20 million. Step 1. Identify the contract with the customer. What's the contract? ABC PLC signs a contract with XYZ PLC. That's very easy. Step 2. Identify the performance obligations in the contract. What was the performance obligation in this contract? It's to supply a machine. Step 3. Determine the transaction price. In this example, the transaction price is rupees 20 million. Step 4. Allocate the transaction price between performance obligations. In this example, we have only one performance obligation. That's the supply of this machine. Therefore, the allocation has to be done like this. Rupees 20 million is allocated to the sale. Step 5. Recognize revenue when a performance obligation is satisfied. When you are going to recognize your revenue, rupees 20 million is recognized once the machine is delivered. Now we are going to do another example. Example 2. ABC PLC signs a contract to sell a machine to XYZ PLC and provide 1 year service for 23 million rupees. Now in this question, ABC PLC has promised to do 2 things. That is to supply the machine and provide 1 year service. The same machine is usually sold without the service for rupees 20 million and the service is separately performed for rupees 3 million. Now we are going to write 5 steps. You have to be very clear about who is the seller, who is the buyer, and what's the total amount connected with this transaction. What are the performance obligations? And how we are going to recognize your revenue upon the performance obligation. Now take 3 minutes and write down all 5 steps of the revenue model. Now you can see that my answer format is ready. I have written all 5 steps and I have kept some space under each step to write the answer. Now we are going to write down all answers for this revenue model. Again, read the transaction. ABC PLC signs a contract to sell a machine to XYZ PLC and to provide 1 year service. The total value is 23 million. The supply value is 20 million and the 1 year service value is 3 million. Now we are going to write 5 steps. Step 1. Identify the contract with the customer. Who are the parties involved? That's ABC PLC and XYZ PLC. Therefore, you are going to write step 1 as ABC PLC signs a contract with XYZ PLC. Step 2. Identify the performance obligations in the contract. In this contract, you have 2 performance obligations. You are going to write down those 2. Number 1, supply a machine. Number 2, provide 1 year service. Step 3, determine the transaction price. What's the total transaction price? It's rupees 23 million. Step 4, allocate the transaction price between performance obligations. You had 2 performance obligations. Therefore, you have to allocate the transaction price in 2 steps. Number 1, rupees 20 million is allocated to the sale of the machine. Number 2, rupees 3 million is allocated for 1 year service. Step 5. Recognize revenue when a performance obligation is satisfied. You had 2 performance obligations. Therefore, step 5 should be written under 2 parts. Number 1, rupees 20 million is recognized once the machine is delivered. Number 2, rupees 3 million is recognized once the 1 year service is performed. Presentation. Present the performance of a contract in statement of financial position as a contract asset or contract liability, depending on the relationship between the entity's performance and the customer's payment. Now we are going to study about contract assets and contract liabilities. Contract asset. An entity's right to consideration in exchange for goods or services that the entity has transferred to the customer. Entity has already transferred, but the entity has not received the full consideration. Therefore, that will be classified as contract asset. The determination criteria is entity's level of performance and the customer's payment. Now here, entity has performed, but the customer has not paid. Therefore, that will be categorized as contract asset. Contract liability. An entity's obligation to transfer goods or services to a customer for which the entity has received consideration from the customer. What do you mean by that? Now here, entity has received the payment. Customer has paid money. Therefore, the entity has received the payment. But entity has not satisfied the performance obligation. Therefore, that will be categorized as contract liability. Disclosure requirements. An entity shall disclose the qualitative and quantitative information for all of the following. First part, contracts with customers. These disclosures include the disaggregation of revenue into appropriate categories, presentation of opening and closing balances of contract assets and contract liabilities, and significant information relating to their performance obligations. Number 2, significant judgments. These disclosures include judgments and changes in these judgments that affects the determination of the transaction price, the allocation of the transaction price, and the determination of the timing of revenue. Number 3, assets recognized from the cost to obtain or fulfill a contract. These disclosures include the closing balances of assets recognized to obtain or fulfill a contract, the amount of amortization recognized, and the method used for amortization.